Good afternoon, everybody, and my name's Andy Dyson. I'm the Chief Executive of ISLA, and welcome to the next session of this year's post-trade event. Just by way of initial thanks, I'd like to just reference the previous session from Carmine for his very thoughtful and incisive comments. I think as a prelude to our second day, they provided a great opening backdrop for the discussions over the next few hours. After that most interesting of sessions, I'm actually now really delighted to welcome our next guest, Rupert Perry. Um, this next 20 minutes or so is an opportunity to talk to I think in certainly my eyes, one of the most visionary and forward-thinking individuals that we've seen in our market for many years, particularly around post-trade. As we begin the session, I would just like to thank our sponsors for this particular discussion, which is Market Access. Of course, you can find out a lot more about their products and services via their pages on the event platform. Okay, so let's get going. First, absolutely delighted to have the opportunity to talk to Rupert, who, as I said, is truly one of our visionaries and forward thinkers. From the perspective of ISLA, Rupert recognized very early on the importance of post-trade, and in the context of our association, he was one of the very early supporters of this very event. So it's absolutely great to have him here today, probably some 10 years or so since those first events. Just a tiny bit of background about Rupert and Pirim. Pyram Systems was founded in June 2000 by Rupert Perry and Jeff Armstrong with the objective of providing advanced, centralized, and secure automation services for financial market participants. Pyram provides a secure processing hub which seamlessly links those market participants together with allowing them to electronically process and verify key transactions. By combining an in-depth understanding of both securities finance industry and IT, Pyram today has created a set of highly innovative and flexible services which are tailored to fully support the complexities of the underlying businesses that we're all part of today. Pyram's innovation around design and focus on customer services has led to multiple industry awards over the years, most recently winning the ISF 2020 Global Post Trade Service Provider Year Award and several individual category awards, including innovation, client service, and the proportion of support for straight-through processing. Pyram's client base is over 100 financial institutions, including investment banks, asset managers, pension funds, insurance companies, and of course, agent lenders. In 2015, Rupert became a non-executive member of Pyram's board of directors, and he continues to provide strategic advice to the company and their executive management team. And finally, just in case anyone was wondering about the name Pyram, Pyram is Latin translation for the word pear, which itself was drawn from two letters of each of the surnames of Rupert and Jeff, just in case you were wondering. Okay, on to the questions. And again, welcome to Rupert. First question, Rupert, over to you on this one. Over the 20 or so years that Pyram have been providing post-trade services, what are the biggest changes that you've seen in the post-trade arena?
Well, good afternoon, Andy. And of course, there's been masses of changes in the last 20 years. Perhaps I could start by taking you back to, to the world of 20 years ago when operations teams were generally communicating with each other over fax, email, and with telephones. The internet was still in the very, very early stages of adoption at that point. In fact, I recall one of the sort of the early I suppose, drivers for me thinking about what you could do with the internet was the Hotmail service, which was what I saw as the first actual application that ran on the internet. Before that, internet websites were pretty much sort of static data affairs, publishing information, sort of reports for companies and things like that. There wasn't much in the way of what we these days think of as sort of more dynamic application type sites. So we saw that there was an opportunity to develop a sort of a platform that would sit in the middle of the industry, and that would enable you to do, things like contract and billing compare, and then billing delivery, and ultimately, of course, it led on to many more things. But let me just start with maybe with a story of some of the clients that we used to see in those very early days. I remember going to see clients who had sometimes months of billing that they couldn't actually deal with, and they had large numbers of paper bill statements. In fact, when I went to see somebody in New York, I remember seeing a client where literally their desk was surrounded with billing statements that were piled sometimes 3 foot high, and they're trying to work out, why the number at the end of that bill was different between what they saw and what the counterparty was seeing. And it was a really, really hard work for them. They'd literally have to go through line by line, looking at the sort of the totals by security and trying to work out, where those differences were. So the introduction of the sort of electronic platforms for doing, compare like we brought in also facilitated, I would say, quite a significant change in the way that things were operated. In London, at least, you generally had operations desks working quite closely with trading desks, and they were usually co-located, certainly in the same building, and often very close to each other. And of course, what we've seen over the last 20 years is a massive outsourcing of operations. And in many ways, the platforms that people like Pyram have developed have helped facilitate that, because they've taken information that was otherwise, in written form and being delivered physically to from one organization to another, and they put it on screen and enable people to do it pretty much in any part of the world. So now, of course, we see many more people based in lower cost regions of the world. The fact that there's also been a lot of extra trade automation and electrification has meant that we've got a far higher trade volume being processed than we ever had before. And we've also now got much more interest from the front office in post-trade issues. And this has really been driven by, sort of the increased regulation, the sort of greater need for oversight. There's also been a need to, reduce costs, particularly since the financial crisis in 2008, with sort of lower margins available in the business. And there's been, as a result of all of that, much more interest in collateral management across operational silos and optimizing for capital efficiency, driven by things like the liquidity coverage ratio and more stringent capital rules that have come in around all of that. So that's been sort of the backdrop. And of course, as part
Okay.
of that, I think Isla's been, a great contributor to that, particularly with all of the best practice groups that I remember participating in the early days that helped to encourage people to use a lot of the automation that's available.
Okay, Rupert. Yeah, thanks for that comment about what we do at ISLA, because you know the what I always said to people when they join the association as members is, whilst you quite like the idea of this external facing front office association, which we are, the real values in what we do in things like best practice for post trade. And I think some of the things you're saying that sort of support that. Okay, so look, next question. As you look at the market today, and it's a very different market to perhaps one that you were describing in those early days of piles of paper around desks and offices. What do you think the biggest challenges facing the industry from a post-trade perspective are today?
Well, let me start my answer for that by looking at perhaps what sort of nirvana might look like for
Mm,
post trade, and then we can assess the challenges to that. So I would say the industry goal for post trade should be for every trade to be processed right first time with full STP without anyone having to manually intervene at all. So what that basically means is no breaks, nothing, and everything goes straight through pretty much without touching the walls. On the collateral side, we'd want to see collateral requirements being calculated and optimized fully automatically as well. So what are the challenges that we've got with achieving this? Well, firstly, I would say ensuring market-wide adoption of the automation that's available today. I've lost count of how many of those best practice meetings that I went to where everybody said, "Well, wouldn't we really need everybody to be on all the platforms," and that is absolutely as true today as it ever was, albeit these days it's more about the sort of the more recent services than contract compare and billing compare, which are generally pretty well used these days. But we've still got a lot of clients out in the market that are in the process of rolling out automation for things like returns and marks, tri-party RQV, and exposure. So the first thing clearly is getting adoption of the automation that's already available. Having done so, the next challenge, I would say, is in improving upstream data quality to ensure that all the downstream STP works. Unfortunately, historic underinvestment in operations and old systems often mean that fixing the data issues is much harder for some participants than it is for others. Putting in new systems is always a big ask, and not many are replaced each year. So generally what we tend to find is that people who are doing client relationship reviews, they tend to look at the sort of issues that are being experienced, and with the sort of existing bilateral automation, and in my experience, generally clients are already choosing to direct business where it can be transacted most efficiently. In other words, those who've got perhaps sort of the best automation that's working very, very well. Then
Okay.
beyond that, I would say we clearly need to be reducing breaks and exceptions, and it's a big challenge. We all need to reassess why those breaks are occurring, and we need to re-engineer the business processes accordingly. Breaks are exceptions to the STP, and they're costly to manage, and basically we need to get rid of them. They're also going to be, I think, increasingly unacceptable from a regulatory perspective. And then we've
Okay.
got a sort of significant challenge in completing all of the post-trade process automation. So we haven't yet automated everything in post-trade. For example, trade amendments, cancellations, rate changes, recalls, fund swaps, corporate actions. And certainly as part of Pyram's new tech initiative, we're already talking to clients about fixing those.
Okay. That's fascinating. And you mentioned about sort of the evolution and where we are today and what might happen next. I was going to just ask you a little bit now about Europe is this quite unique place that's had a lot of regulation, perhaps more in the post-trade space than we've almost seen anywhere else globally. How important has that been in shaping the post-trade world today?
Gosh, yes, it's been a huge driver of change in the certainly in the European market, but I think even beyond that too. We're still in the early days of SFTR, but I think that
Mm.
ultimately the regulators are going to expect accurate matching data to be reported, and they will find market participants that don't report on a timely basis, or if they report inaccurately. CSDR is another one that's going to bring settlement discipline and fines for failing. We've got UMR still the sort of final stages of that to go. That means you've got many more collateral requirements that need to be looked after. And looking forward to Basel 4, firms obviously going to need even more sort of collateral optimizations and capital efficiency than they've had previously. So I think as a consequence of all of those things, the industry does recognize that operational practice really has to improve substantially. And even in regions where the regulations don't yet apply, we're finding that clients are adopting more automation anyway because they can see that there are significant operational cost and risk benefits. Let me give an example maybe of that. We at Pyram, we always try to get people in the repo market onto our platform. And in the mid 2000s, we found that that was actually generally quite difficult because in the repo market, volumes were generally a bit lower and there was a feeling that they could manage without actual automation. But of course, with SFTR and the need there, they really don't have any choice now. And we're finding there's a much greater uptake in those sort of markets, clearly been driven by regulations. Taking a bit of a closer look at SFTR specifically, because I think that is really
Mm.
interesting. A UTI, of course, is now required for every trade, and this generally means you've got to use an electronic platform, you've got to have electronic compare at a minimum. UTIs bring one-for-one hard linking of trades. And so what that means is that the automation of life cycle events, for example, marks and returns, becomes absolutely essential to maintain matching records between the borrower and the lender. Because if you don't, what happens is you might process a mark or return against a different contract, and that in turn causes a problem on SFTR comparison because you've got this hard linking of the trades right from the very beginning. So what we see after that, and I've been looking at the data, it's really interesting, but SFTR breaks basically are far more numerous than they are in contract compare, and they're generally speaking much harder to fix. So it's worth pointing out, I think, that contract compare is a much more forgiving economic position match on a many-to-many basis instead of trade by trade. So you get the high volume of breaks in SFTR, which are basically caused by having many more trades, fund level rather than street level compare, by having hard linking of those trades, which means that all the life cycle events have to be processed on matching trades, whereas not everybody's yet automated to that level, and by having many more fields being compared with much tighter tolerances. I know everybody was talking about sort of like 160 fields being compared, and it is an absolutely huge number. Let me give a really simple example. I was looking at this in preparation for this session. On contract compare, I found basically sort of a matching position where we could see contract compare and the SFTR compare. Some people think they're exactly the same, but you'll see from this that they aren't. So the position that I chose on contract compare, it was two trades that were fully matched in contract compare with no breaks. They had identical quantity, they had identical loan value, the dividend rate was identical, the fee rate was identical. There was nothing wrong with it. And basically in contract compare, we said it was completely matched. In SFTR, those same two trades are actually 5 paired transactions, and they're broken on security price, currency, loan value, termination optionality, security classification, currency of nominal amount, security quality, issuer jurisdiction, issuer LEI, security type, market value, collateral basket identifier, general collateral indicator, and security maturity date. And I can assure you that this was a pretty typical type of comparison. So basically, you've got a long list of differences in reasons. So, and the regulators, of course, they can now see all of this stuff because this is what they are looking at. They're not looking at contract compare; they're looking at the SFTR compare that you get in the repository. But it does mean that they can now see the quality and the data accuracy issues that you've got. And some of that, of course, in SFTR is caused by confusion. So, for example, loan value in SFTR is not loan value as we know it in contract compare, which is in loan currency, but in SFTR, loan value is in market currency, except that I think there's quite a lot of confusion going on in the market because I'm seeing stuff, there where we've got matches on loan value in contract compare, and we're nowhere near matching in SFTR comparison, which kind of suggests that maybe there's still some data differences and so on.
And Rupert, and it sounds like there's still a lot of work to do there. Actually, we're coming to the end of our allotted time, and I did just want to just give a couple of moments to my final question, which is, you've helped form much of the post-trade world as we see it today, and I think everyone on this watching this will have some type of relationship with Pyram. So, two quick questions in the couple of minutes we've got left. What are the most important lessons you've learned in the past 20 years with your work around Pyram, and what would be the final thought you'd leave with the audience?
Well, I would say having worked at both a bank and at Pyram, I've come to appreciate that the market-wide change is much harder to achieve than changes within a single organization. So a whole community has to be persuaded to upgrade their systems and processes for everyone to benefit, and this takes time. Market participants are all at different stages of their own systems evolution, and they have their own development priorities. And then, so whilst market-wide progress can seem slow from year to year, it's easier to appreciate in the rearview mirror over longer periods. So whilst Pyram started life back in 2000 with a vision to use the internet to connect the stock lending market together, after the first 10 years, we'd persuaded a majority of market participants to use our electronic contract and billing compare. And starting just over 10 years ago, we introduced our innovative near real-time services, and that sort of marks exposure management, tri-party RQV, returns, payments, and loan release. And now most players are starting to benefit from those services, but they're still very much in rollout. In recent years, we've built collateral management solution, and that's starting to get adopted more widely. And we built a solution for regulatory reporting in partnership with IHS Markit, which has already enjoyed widespread adoption across most of our market. So what I'd say finally, I mean, with a strong team of people who really know the business and who understand how to apply technology to develop a compelling vision for the future. Market participants can be persuaded to adopt new and improved technology solutions. I've been fortunate to be part of such a team at Pyram over the last 20 years, and I fully expect that in another 10 years, that further substantial progress will have been made. By then, the market will have more automated STP processing, more accurate records with many fewer breaks, and this will, of course, mean even higher volumes can be managed at a lower cost than today.
Rupert, absolutely. Thank you for that final comment. We've run out of time, unfortunately. I think we could have carried on listening to your thoughts for quite some time. Unfortunately, we're out of time. In closing, I'd just like to thank you once again for your most interesting and thought-provoking comments, especially about what we might see in the future. In terms of the audience, I would now like to direct you to the imminent coffee break, during which I would encourage all of you to visit the pages of our sponsors through the event platform. And our next live session commences at 1 o'clock UK time. Many thanks for attending this session.